U.S. stocks are facing pressure this morning due to renewed tensions in the Middle East, potentially ending a 9-day winning streak. Here's everything you need to know about the unfolding situation and its implications for the markets. As we look ahead, there are several possible outcomes stemming from today's events. The recent escalation in conflict has raised alarms across global markets, prompting analysts to reassess their forecasts. One scenario involves further escalation, which could lead to a spike in oil prices and increased volatility in equity markets. Historically, conflicts in oil-rich regions have triggered supply concerns, resulting in rapid price increases that ripple through the global economy. If this occurs, we may see a rapid de-risking across sectors as investors pull back from riskier assets, potentially triggering a market correction. On the other hand, another potential outcome is a stabilization of the geopolitical situation. Should diplomatic efforts succeed, markets might refocus on earnings and growth, which are fundamental drivers of investment. In this scenario, the recent momentum from earnings reports could help sustain market confidence despite the surrounding turmoil. Experts are closely monitoring key indicators such as oil prices and bond yields, which will be crucial in determining market direction in the coming days. A surge in oil prices or a significant rise in bond yields could exacerbate inflation concerns, further impacting consumer spending and corporate profits. Conversely, if the conflict remains contained, investors may regain confidence, leading to a recovery in stock prices. As we navigate this complex landscape, a key question remains: how will these geopolitical tensions shape investor sentiment in the coming weeks? The strategies employed by investors will be pivotal in determining market resilience. With this in mind, the focus will be on upcoming economic data releases and geopolitical developments that could influence market stability. The next few weeks will be critical in shaping the trajectory of both the economy and investor behavior. The current situation in the markets has roots that extend back several months. U.S. stock markets had just notched new record highs, driven by optimism surrounding economic recovery and a broadening rally that seemed to include a wider range of stocks beyond just the mega-cap names. This rally, however, made the market more vulnerable to macro shocks. In the weeks leading up to today, strong economic indicators, such as robust employment numbers and rising consumer spending, bolstered investor confidence, creating an environment where valuations were stretched and positioning increasingly optimistic. As geopolitical tensions escalated, particularly around Iran, this fragile state was exacerbated. Historical precedents show that previous instances of geopolitical tension often precipitated market corrections, but the timing of this event, coinciding with a peak period of optimism, sets it apart. Key players in the market had been focused on the potential for sustained growth, but the sudden emergence of international conflict has dramatically shifted their focus. The decisions made by central banks, including interest rate adjustments and quantitative easing measures, combined with geopolitical leaders' actions over the past months, have crafted a landscape where investor sentiment can rapidly shift. This volatility has led to increased sell-offs, highlighting the interconnectedness of global markets. The impact of these developments has not only affected stock valuations, but has also raised concerns about inflation and supply chain disruptions, which could linger for months. Looking ahead, investors will need to navigate this uncertain environment carefully. Analysts suggest that market participants should brace for continued volatility as geopolitical developments unfold. The focus will likely shift to how central banks respond to these pressures, especially regarding their accommodative policies, which may need to be reevaluated in light of evolving economic conditions. The renewed tensions in the Middle East have immediate and significant implications for global markets. Over the past few weeks, escalating conflicts in the region have prompted widespread concern among investors and analysts alike. These tensions are not new. They are rooted in long-standing geopolitical rivalries and issues, including territorial disputes and sectarian divisions. As a result, investors are facing higher volatility since conflict-driven headlines can trigger rapid swings in equities, oil prices, gold, and bonds. Historically, such conflicts have led to increased uncertainty in the markets, as geopolitical risks often lead to sudden shifts in investor sentiment. The recent release of stronger than expected payroll data adds another layer of complexity to the current economic landscape. This data has heightened fears that the Federal Reserve may adopt a more cautious stance in its monetary policy, particularly if inflation risks emerge from rising energy costs. The immediate impact of these developments is felt across various sectors, with a potential for de-risking as investors reassess their portfolios in light of increased uncertainty. The scale of the impact is considerable. For instance, a spike in oil prices could significantly affect global economies, particularly those that are heavily reliant on energy imports. Furthermore, uncertainty in bond yields could lead to further market instability, complicating the financial landscape for businesses and consumers alike. The average person should care about this situation because it can influence everything from gas prices at the pump to the overall economic climate. When markets are volatile, it can lead to broader economic consequences, including slower economic growth and increased costs of living. With the market already fragile due to stretched valuations and investor optimism, any escalation could lead to a significant downturn, negatively impacting not just investors, but also the everyday consumer who relies on stable economic conditions. Looking ahead, the potential for continued volatility remains high. Investors will need to navigate this uncertain terrain carefully, as geopolitical developments and economic indicators could dictate market performance in the coming months. The outlook suggests that vigilance will be key, as both policymakers and investors respond to the evolving situation in the Middle East and its broader implications for the global economy. In the early hours of June 4, 2026, U.S. stock markets opened flat to lower as investors reacted to escalating hostilities related to Iran. This geopolitical shock comes at a time when markets were nearing record highs, with the S&P 500 poised for a potential 10-session winning streak, the first since 1995. The combination of these tensions and stronger than expected economic data, specifically the May private payrolls growth of 122,000, raised significant concerns for market participants. Investors are now grappling with the dual risks of geopolitical instability and the prospect of elevated interest rates. The backdrop to these developments is a complex web of international relations, where Iran's recent military maneuvers have heightened fears of broader conflict in the Middle East. This region has historically been a flashpoint for economic volatility, particularly due to its pivotal role in global oil supply. As tensions flare, oil prices are likely to respond, adding another layer of uncertainty to an already fragile market. As the trading day progresses, these factors are likely to weigh heavily on investor sentiment, threatening to disrupt the recent broadening rally that had finally begun to extend beyond a narrow group of mega-cap stocks. The most shocking element of today's events is the timing of this geopolitical crisis, which comes just as optimism about economic recovery was at its peak following the pandemic. Unlike previous market corrections that were often triggered by economic downturns, this latest challenge originates from international tensions, making it a unique risk factor that could lead to rapid swings in market performance. The market's fragile state, characterized by stretched valuations and heightened investor optimism, makes it particularly susceptible to these external shocks. The current environment raises the stakes for traders watching the unfolding situation closely. With the Federal Reserve's potential interest rate hikes looming, the interplay between geopolitical tensions and domestic economic policies will be critical. As investors navigate this uncertain terrain, they must brace for volatility while keeping a vigilant eye on developments in Iran and their potential implications on the global economy. The coming weeks will be pivotal in determining whether the market can sustain its momentum or faces a significant correction. What will be the impact of these geopolitical tensions on investor sentiment and market stability? Share your thoughts in the comments below and subscribe for daily deep dives into the latest financial news.